Super Thursday is fast approaching, and until just a few weeks ago, a May rate hike was almost a dead cert. That was until we heard from the Governor of the Bank of England, Mark Carney, who told markets that it might not happen, and then we had that softer GDP print for the first quarter. Now, I'm pleased to say that I'm joined by a guest, Philip Rush, who is the founder and chief economist of UK macro research house Heteronomics. Phil, thanks so much for joining me. So is May off the table, and if so, when's the next rate hike?
It's not off the table, and the market's pretty much priced it out entirely, but just as 90% was wrong a month ago, pricing it at 10% is probably wrong now. It would be very damaging for credibility if Carney was to turn around, having drawn attention to the importance of the data, and not hike, and actually deliver a hike now. But it's not impossible. There are other members on the committee, and they may be going for it. I think if they do go, the next move will be in August. They'll want to see a full quarter of data to calibrate their model and their forecast.
It's not just the interest rate that we're waiting for on Thursday, it's also that inflation report. What are you expecting there? What should we be looking out for?
So it's the inflation forecast as ever, but it's also their assessment around spare capacity. One of the big hawkish things from February was their new assessment that excess demand was going to build in the forecast. That was going to be intolerable with excess inflation. I think that both of those things will persist. So still a bit of excess demand, still a bit of excess inflation, probably a little bit less on both counts than there was in February.
And where do you see the risks? Is it that the central bank moves too quickly or too slowly? And are you concerned about inflation risks to the upside or potential disinflation?
I think we're going to see inflation move a little bit lower, blip higher mid-year before we continue to fall. It's probably going to remain above target though for the next couple of years, and that's going to keep the pressure on the Bank of England to keep gradually hiking interest rates back towards neutral. And that neutral rate, it's not 0.5, it's not 1, it's probably more like 2.
Now, we've seen a significant decline in sterling. The last time I checked, it was down 5.5% since mid-April. I'm wondering whether there's concerns that that could lead to imported inflation if that were to be sustained.
Well, of course, if it was to be sustained, and the move is particularly large in cable, and that's relevant for the sterling dollar price. So the move up in inflation we're likely to see mid-year. That's basically an energy price story, petrol prices, some moves around on British gas and the like. It's not the sort of magnitude yet that's a real problem. This is far smaller than the devaluation we had after Brexit, but it just keeps up the inflationary pressure. A reminder, if you like, that the Bank of England does have a trade-off to manage, that it can't just stand back and not hike forever. It will need to keep going.
Now, there was one report from the IPPR, the think tank, that said that the central bank is dangerously ill-prepared for the next downturn. Do you think that the central bank should raise rates in order to create a monetary buffer in case of recessionary situation?
That shouldn't be the sole justification for it, and to the extent that we're going to get a big downturn at some stage, that would be magnified through the financial system. And so the measures that the Bank of England are doing on the macro-prudential side are the real ward against that rather than interest rates. Getting interest rates back up towards neutral though, which would be the consistent position for an economy with pretty much no spare capacity left, that is something that it should be aspiring to do in the not too distant future.
Now, if we look at the data picture, we've been seeing a few softer prints, whether it's from GDP or services, PMI, or indeed the CPI, which was at the lowest level in a year. I'm wondering whether you can solely attribute that to seasonal temporary factors or whether there could be the early signs of some kind of a slowdown here.
That's certainly the concern of the bank and why they've placed more emphasis on the data recently and why they look to be delaying their hike from May. In my view, some of the weakness that we had in Q1 is probably going to be revised away, in particular construction. That knocked off 0.2 from GDP growth, but there are persistent revisions of 1 percentage point per month to those data on the upside. So I think that the Q1 GDP numbers are probably going to get nudged up a little bit. Services PMI is probably the most overrated series in the UK, has a negative correlation with the equivalent service sector activity measure. So I think that we'll probably be back to something like the old pace of growth that we've had over the previous year for Q2 and indeed beyond that. So I'm not too concerned about that.
Now, we saw the Bank of England cut rates after the Brexit referendum, and I'm wondering whether there's anything on the impending Brexit timeline that could shift the monetary policy path.
Well, it's the risk of a disorderly Brexit, and that's kind of on the back burner for now. So long as negotiations are moving forward, and agents in the economy, businesses, people, so long as they think that things are going to proceed smoothly, it's not that big an economic shock to deal with. It's a protracted, slow wait on the economy rather than the sort of recessionary shock that would be scaring the bank.
And you still think that a hard Brexit is likely?
I still think a hard Brexit is likely, but we'll be transitioning over a couple of years towards that hard Brexit, which gives time for people to adjust to it and essentially lowers potential growth for a few years.
Now, the Governor of the Bank of England, Mark Carney, ends his term in June 2019. I'm wondering if you have any insight into potential succession plans. I know Andy Haldane's name has been thrown out there.
Yeah, and Andy's good. He's probably a bit junior for the role, to be honest. And the requirements for it are someone who has experience on macroprudential and conventional monetary policy, which Andy does have. But they also need to have an international standing reputation. And for me, of the MPC, that probably means Dave Ramsden. He was instrumental in hiring pretty much everybody onto the MPC. He sat on all the meetings for a very long time. He's done G20. He's well known and well respected on all the requirements that they need. Otherwise, you may be looking for someone actually who's from that international background, and again, from the Bank of England side, probably Don Cohn. Those of us who remember him from the Fed days remember King Cohn, very good communicator and all the right credentials.
Thank you so much. That was Philip Rush, founder and chief economist at Heteronomics. I'm Victoria Scholar. Thanks so much for watching IGTV. Good luck trading. See you soon.
Subscribe to IG for educational content, company insight, financial analysis and expert commentary.